IENOVA, leading company and only pure play stock in Mexico's private energy sector, is the best investment vehicle to play the historical changes provided by the local energy reform. Good morning, ladies and gentlemen. We are Tania, Alejandro, Didier, Guillermo, and Carlos. We represent Tecnológico de Monterrey, Mexico City Campus, and it's our pleasure to present our initiation coverage for IENOVA. We issue a buy recommendation for IENOVA, largest and most experienced natural gas pipeline operator in Mexico. IENOVA's low-risk business, solid expertise, and strong parent company support derive in a competitive advantage to capitalize in infrastructure opportunities. The recent energy reform and the underdeveloped energy infrastructure grant unique expansion opportunities to the company. Their business model consists in long-term, take-or-pay, dollar-denominated contracts that provide constant and predictable cash flow that support our double-digit EBITDA growth in 2019. In addition, its financial flexibility and disciplined investment strategy reinforce our buy recommendation, embracing a target price for December 2016 of 82 Mexican pesos, implying a potential upside of 18.7%.
IENOVA develops, builds, and operates energy infrastructure in Mexico since 1996. It is a subsidiary of CFA-IRC and relies on two business segments, gas and power. Gas is the most relevant in terms of revenue and EBITDA for the company. It is divided in transportation, sales, distribution, and storage and regasification. The company has invested over $4 billion in energy infrastructure in Mexico. This includes over 1,400 kilometers of pipelines across the country, 6 compression stations, thermoelectric plants, and a wind generation facility. The company is the only pure play stock available to invest in the Mexican energy sector. It has 31% of the country's pipelines and 50% of the national storage capacity. It is worth to highlight that the company's technical capacity, financial flexibility, geographical strategic position, and diversified asset portfolio, along with the top-notch management, deriving a competitive advantage to take all the infrastructure projects that the market requires. Top-notch management has a very strict investment policy that avoids projects with low rates of return. In addition, a collective know-how of government bids, infrastructure projects, and state-owned companies has allowed IENOVA a historical hit ratio of 65% in bids. The company recently acquired total control of 4 assets from its former joint venture with Pemex. Pemex is one of the world's top 10 oil producers and the state-owned company. This is expected to increase by 15% the transport capacity and double the revenues in the sales segment. In order to finance the acquisition, IENOVA will contract a bridge loan with CFA-IRC, which is expected to be paid with a follow-on emission of 330 million shares.
Mexico has room for solid and steady growth in the power transmission and energy infrastructure sector as a result of the energy reform. Electricity opportunities are starting to become a reality as Mexican authorities have set the rules for New Mexico's electricity market, allowing for the first time private investment in the transmission business. Government recently published the long-term development plan for the electric national system, which includes new generation of power plants, interconnection with U.S. cross-border facilities, renewable energy auctions, and clean energy certificates. Power demand is expected to post a 4% CAGR until 2027, backed by solid supply-demand dynamics and an incremental demand from the industrial sector. In addition, government has set the goal to generate 35% of the nation's electricity from non-fossil sources. Parent company Sempra has proven experience in these businesses, which represents an effortless entrance for IENOVA into these new business opportunities. Natural gas demand is expected to post a 3.6% CAGR until 2027. As of December of 2015, the shortage gap between foreseen demand and current capacity stands at 30%. However, it is expected that by 2020, imports via pipelines will see an increase of 160%. Mexican government also recently announced a quinquennial program that aims the construction of 8,000 kilometers of additional natural gas pipelines, representing a 70% increase and an aggregate investment of $10 billion.
In our model, revenue was estimated independently for each segment, gas and power. The forecast for each business line is defined by variables such as volume capacity, gas prices, inflation, and demand. As an example, the transportation revenue forecast considers the capacity of current assets, projects under construction, the recently acquired assets, and the future capacity of prospective projects. We also took in account change in gas prices and regulatory fees. The aforementioned elements will result in a revenue increase of the 91% on the transportation segment. Subsequently, Genova's revenue will stand at $1 billion, representing a 50% increase from 2015. In order to best approach Genova's growth, we estimated a target price based on a 3-stage discounted cash flow valuation. We consider a 4.5% growth rate for the second stage and a 3% terminal growth rate, which we consider to be rather conservative based on the industry outlook. Target price was calculated with an 8% WACC, assuming a 4.7% cost of debt and a 9.1% cost of equity. In addition, our model considers the equity dilution announced by the company, the acquisition of the joint venture with Pemex, and the reinvestment of operating cash flows. The outcome of this model is a target price for the end of 2016 of 82 pesos, implying a potential upside of 18%.
Relative valuation reveals that Genova has a forward-looking EV/EBITDA slightly higher than its peers. However, this analysis was not included in our model because there are no local peers with publicly available information, and foreign companies compete in very different markets with asymmetric growth expectations. Genova's low-risk businesses, supported by take-or-pay contracts, make the stock appear as a dollar-denominated corporate value. Nevertheless, due to the completion and operation of under-construction projects, we anticipate a compound annual growth rate in revenue of 7.6% from 2015 to 2019. Similarly, we expect an EBITDA increase of 22% from 2015 to 2016.
We strongly believe asset optimization, M&A opportunities, Pemex, and the Federal of Commission Electricity divestitures are key factors that will most likely lead to value creation. We anticipate an 11% return on assets for the next 5 years and a 6.5% return on equity due to the progressive beginning of operations of currently under construction assets. Genova's current net debt EBITDA is 3.3 times, while the median of its comps is 5.4 times. Genova's lower leverage offers greater financial flexibility and represents a booster for achieving higher growth rates. Our target price was calculated based on current projects, projects under construction, and future bids. However, it should be highlighted that 92% of our target price is guaranteed by current projects and the legacy of projects under construction, leaving only 8% variable to future bids.
Genova faces the risk of the strengthening of their competitors, as they could have access to lower cost financing sources. This might affect the company's chances of being awarded a project, leading to potential lower returns annually. We estimated the effect on the target price based on the likelihood of winning the expected amount of government bids. Unless the company's hit ratio declines from its actual 55% to 20%, we will not change our buy recommendation into a hold. Furthermore, we believe that given its track record of first mover advantage, the company will continue to attain new large-scale profitable projects. Correlation with commodities might affect significantly Genova's revenues. Gas segment, which is expected to account for 82% of total revenues in 2016, has shown recent fragility in sales and distribution businesses. For this risk, it will take a decline of 40% in our estimated gas prices to turn our buy recommendation into a sell. Nevertheless, we're expecting gas segment revenues to climb up to 8.71% annually until 2021. The exchange rate is a significant risk for the investors because the US dollar is Genova's functional currency while its stock price is quoted in Mexican pesos, thus making equity valuation sensitive to changes in the FX rate. In the past 12 months, Mexico's currency has suffered a 15% depreciation against the US dollar, which according to our stress test should stand above 16.10 pesos to maintain our buy recommendation. To sum up, Genova is the best bet to play Mexico's energy sector, grounded on the promising opportunities arising from the energy reform in combination with a strong balance sheet, financial flexibility, and top-notch management. Ladies and gentlemen, the aforementioned elements support our target price for the end of December 2016 of 82 pesos, implying a potential upside of 18.7% from its closing price of 69 pesos and 4 cents, reinforcing our buy recommendation for Genova. Thank you very much for your attention, and we are now ready for questions.